Welcome to the deep dive. We're here to cut through the noise and give you the clarity you need. Today, we're tackling a really big financial topic, one that's definitely on the minds of many homeowners, particularly as they get closer to or are actually in retirement. And that's how to unlock the wealth that's tied up in your home. We've seen some pretty striking figures lately. I mean, a record £6.2 billion released from property back in 2022. And get this, a 32% jump in equity release just between the first quarter of 2024 and the first quarter of 2025. So these numbers really paint a picture, don't they? Many of us are asset rich, sitting on property value, but maybe feeling a bit, well, cash poor sometimes. Our deep dive today is all about equity release. Think of it as a way to turn some of that home value into tax-free cash. And often, you don't even need to think about moving house. Now, it sounds potentially like a lifeline for some, right? But like any powerful financial tool, it's complex. It has layers, promises, yes, but also potential traps. So our mission here is to arm you with the essential facts, maybe some surprising insights too, and just a really clear understanding. Could equity release be the right move for your specific situation? This is for you, the homeowner, probably 55 or older, maybe looking to boost retirement income or just seeking a bit more financial stability. It's a huge decision. So let's really dig into what it means, beyond the headlines.
Okay, let's unpack this then. I imagine many listeners are sitting in their homes right now, homes they love, maybe wrestling with that whole asset rich, cash poor thing. They've probably heard the term equity release thrown around, but what does it really mean for them? Especially thinking about, well, their biggest asset.
Yeah, that's a great way to frame it. Basically, your equity is simply the market value of your home minus whatever's left in the mortgage, if anything. So equity release lets you tap into that wealth while you carry on living there comfortably. It's mainly aimed at UK homeowners, typically aged 55 plus. The property needs to be your main residence, usually worth at least, say, £70,000 or £75,000. It's really about turning those bricks and mortars into cash you can actually use.
Right. So you're accessing your home's value, but crucially, without giving up ownership right away, or maybe ever in some cases. But I guess, like most financial products, it's not just a single thing. What are the main ways people actually do this? How different are they fundamentally?
You're spot on. There are two main types, and yeah, getting the difference is absolutely vital. First, and definitely the most common, is a lifetime mortgage. With this, you borrow a lump sum, basically a loan secured against your house. Now, here's the really flexible part. You can choose not to make any monthly repayments. The interest just rolls up, it compounds. Or you can choose to make voluntary payments, maybe just cover the interest or pay off a bit of the capital. The loan, plus all that accrued interest, only gets repaid when you pass away, or if you need to move into permanent long-term care. And typically, you can borrow somewhere between, say, 20% and 60% of your home's value. That percentage often goes up a bit as you get older, too.
Okay, that explanation of a lifetime mortgage makes sense. That flexibility around payments or no payments must be a huge draw for a lot of people. But you said two types. What's the other one? You mentioned it's quite different. How does that work, the home reversion plan?
Yes. The second type is home reversion. And it's a completely different approach, really. Instead of a loan, you actually sell a part or even all of your home to a provider. In return, you get a lump sum or maybe regular payments. But the crucial bit is you get a legal right to live there rent-free for the rest of your life. Now, the big difference, the catch if you like, is you won't get the full market value for the share you sell. It can often be as low as 20%, maybe up to 60% maximum of what it's actually worth. The minimum age for this is usually a bit higher, around 60. And interestingly, sometimes your health can affect the offer. Poor health might mean a slightly better offer, percentage-wise.
Wow. Okay. So yeah, not just two options, but two totally different ways of thinking about how you access that value. Getting those differences clear is so important, isn't it? It really sets the stage for understanding the pros and cons. Okay, so that's the mechanics sorted. But the real question, the one people wrestle with, is why would I do this? What are the big advantages? The reasons why we're seeing this trend? More and more people considering equity release.
Well, probably the number one reason is getting hold of tax-free cash without having to sell up and move. Because it's treated as a loan, not income, the money you release doesn't get taxed. It just lands in your account. And you can take it as one lump sum or often set up a drawdown facility, taking chunks of money only when you need them. This cash can make a massive difference to retirement income, especially when you think, what is it, around £12,800 a year is seen as the minimum for a single retiree to live comfortably in the UK. This can help bridge that gap.
And the big one, you get to stay put. in your own home. That sense of security, the memories, that must be a huge, huge factor.
Absolutely. A massive pro is not needing to move. You keep that security, living in your familiar surroundings for life or till you need permanent care. For people who are really attached to their home, their community, and just don't want the upheaval of downsizing, well, this is incredibly powerful. It lets them age in place.
But life changes, doesn't it? What if your circumstances shift down the line? Maybe you do need or want to move. Does equity release lock you into that specific house forever?
Not always. Many modern plans now come with portability. This basically means the plan can often be moved, transferred to a new property. It is subject to the provider's approval, of course, and their lending rules at the time. So, yeah, while it's designed for the long haul in your current home, it doesn't automatically mean you can never move again.
Okay, that's good to know. And what about those monthly payments? That's often the big worry with any kind of borrowing, isn't it? That monthly outgoing.
Yeah, and this is a major plus point, especially with lifetime mortgages. Most schemes offer flexibility with no mandatory monthly repayments. In fact, there was a key change back in March 2022. All new plans from Equity Release Council members must now allow you to make voluntary payments towards the interest. And they also allow annual repayments, often up to 10% of the original loan amount each year without any penalty. Though the specifics can vary a bit between lenders. But that core flexibility, no forced monthly payments, offers huge peace of mind. It reduces that stress.
So, okay, you've got this tax-free cash, potentially no monthly payments, you can stay home. What does this freedom actually let you do with the money? Is it just for emergencies or?
Oh, the versatility is enormous. And this is where it becomes a really personal strategic decision. We see people using the funds for, well, all sorts. Essential home improvements, adapting the house for later life, helping grandkids with uni fees, which are, huge now, covering unexpected care costs without that awful pressure to sell the family home quickly. Or, yes, sometimes it is for that dream trip, or just boosting the day-to-day retirement pot. We've seen examples like retired couples clearing nagging debts and finally building a savings buffer, or a widow helping her grandchildren get started. It gives options.
Yeah, options and control. It really can provide significant financial freedom, can it? And maybe just as importantly, that peace of mind you mentioned. Right, those are some pretty compelling plus points: tax-free cash, staying put, flexibility. But my gut feeling is always, there's no such thing as a free lunch. Every financial move has downsides, trade-offs. So what are the main risks, the potential pitfalls people really need to be aware of with equity release? What's the other side of this coin?
You're absolutely right to ask that. And yes, there are significant downsides to weigh up. Probably the biggest one for many people is the reduction of inheritance. Let's face it, for most homeowners, their property average price, £285,000 back in March 2023, is their single biggest asset. Taking out equity release will inevitably reduce the value of what's left in your estate. That means less for your children or other beneficiaries. Even if you use things like inheritance protection features, the total amount passed on will be lower. It's a direct trade-off.
Less inheritance. Okay, that's a big one. And you mentioned interest rolling up earlier, that compounding interest. It sounds like it could eat into the home's value quite quickly, couldn't it?
It certainly can, and it's absolutely crucial to understand, especially with lifetime mortgages. Compound interest means if you don't make voluntary payments, the interest gets added to the loan balance each year or even each month. Then, the next lot of interest is calculated on that new, bigger total, so it snowballs. Current interest rates, you're looking typically somewhere between, say, 5.97% and 6.28%-ish. Now, rough rule of thumb, at around 5% interest, if you make no payments, the total debt could potentially double in about 15 years. So yes, it directly and significantly reduces the remaining equity in your property over time.
Wow, doubling every 15 years, that really does make you stop and think, doesn't it? You can see how that could erode a potential inheritance quite dramatically over, say, 20 or 30 years. And how does the wider economy play into this, like current borrowing costs being relatively high in the UK?
Yes, that's a very relevant point right now. UK borrowing costs are currently higher compared to many similar countries, partly due to that sticky inflation we've had. This backdrop makes equity release potentially more expensive today than it might have been a few years ago. So understanding those rates and their long-term impact is even more critical. Now, there is that important safeguard, the Equity Release Council's no negative equity guarantee. That means you, or rather your estate, will never owe more than what the house is eventually sold for, provided, the terms were met and it's sold for the best price reasonably possible. But even with that guarantee, it could still mean the entire value of your property gets used up just repaying the loan and the rolled-up interest, leaving absolutely nothing for beneficiaries.
Right, so the guarantee protects against debt, but not against the inheritance disappearing entirely. What about the home reversion plans? We said they were different. Do they avoid the interest issue, but have other risks?
Exactly. With home reversion schemes, the main risk isn't compound interest, but the fact you won't get full market value for the share of your home you sell. Like we said, it could be as little as 20%, maybe up to 60% max of its actual open market value. So that immediately reduces your equity, right, from day one, which again impacts what you can eventually pass on.
Okay. Are there other sort of knock-on financial effects people might not immediately think about?
Yes, a couple of important ones to flag. Firstly, if you suddenly have access to a large chunk of cash, it can affect your eligibility for certain means-tested state benefits, things like pension credit or maybe help with council tax, because your accessible savings have gone up. Secondly, having an equity release plan might also affect your ability to get other loans in the future. Lenders look at the equity you have left, and releasing equity reduces that.
Right. And what if life throws a curveball? Say you need to end the plan early unexpectedly. Perhaps you decide you do want to downsize after all, or your finances change radically. Are there penalties for getting out early?
There can be, yes. You might face significant early repayment charges if you end the loan much sooner than planned. These products are really designed as long-term commitments for life or until you go into care. However, there's a really important protection here, brought in relatively recently. Equity Release Council standards now mean these charges must be waived if you, or the last borrower on a joint plan, has to move permanently into long-term care. You'd need a doctor's certificate for that, but it's a vital safety net for that specific, often unavoidable situation.
Okay, it's definitely not something to enter into lightly. Careful thought, understanding all these potential downsides just as much as the upsides. It really is a balance, isn't it? So weighing up those pros and cons, it's pretty clear equity release isn't going to be the right answer for everyone. It's just one option on the table. If someone decides, maybe this isn't for me, what other routes could they explore? What are the main alternatives for funding retirement or getting hold of extra cash?
That's such an important point. It's vital to look at the whole picture, not just focus on one product in isolation. An obvious alternative, and often the first one people think of, is simply downsizing. Selling your current, maybe larger, home and moving somewhere smaller, or perhaps less expensive area-wise. This can free up a substantial amount of cash, tax-free usually from your main home sale. Plus, it can lower your ongoing bills, less maintenance, maybe lower council tax. The downsides, of course, are the hassle and stress of moving, the actual costs involved estate agents, solicitors, stamp duty maybe, and, well, the emotional wrench of leaving a home you love.
Yeah, moving home is a big deal, especially later in life. What if staying put is the absolute priority, but you still need more income?
Well, in that case, one option, though not for everyone, is to rent out a room. The government's rent-a-room scheme is quite generous. You can currently earn up to £7,500 a year, completely tax-free, from letting out furnished accommodation in your main home. Of course, the big consideration there is sharing your space. Having someone else living in your home, becoming a landlord, it requires a certain mindset.
True. And what about earning? Many people retiring from their main career aren't necessarily ready to stop working completely.
Absolutely. Continuing to earn in some capacity is a really valid route. Maybe a part-time job, consultancy based on past experience, or turning a hobby into a small business, a side hustle. Retirees often have more flexibility with their time, which can open up possibilities like tutoring, gardening, craft making, driving, lots of things. It keeps you active too, often.
Good point. And what about just using existing savings or exploring different types of borrowing that aren't equity release?
Definitely. Before considering equity release, you should always look at utilizing other savings and investments. That includes things like private pension pots, beyond the tax-free lump sum, maybe drawing down more if needed, though that's taxable income. Also, individual savings accounts, ISAs. Any money you take from an ISA is tax-free. And don't forget lifetime ISAs, leases. If you opened one before age 40, you can contribute up to $4,000 a year until you're 50, get a 25% government bonus on top. And crucially, you can withdraw the money tax-free from age 60. Unlike pension income, LISA withdrawals don't count as income, so they don't affect your tax position. That's a key benefit.
That's a really important distinction about LISAs versus pensions, the tax treatment of withdrawals, worth remembering. Are there any other mortgage-type products designed for older borrowers that sort of bridge the gap?
Yes. There is another option called a retirement interest-only RIO mortgage. Now, unlike a lifetime mortgage where interest rolls up if unpaid with an RIO, you must make monthly interest payments. The big advantage of this is the actual loan amount, the capital you borrowed, doesn't increase over time. So more of your home value is preserved for your beneficiaries eventually. The catch, though, is affordability. You have to prove to the lender that you can reliably afford those monthly interest payments from your retirement income, potentially for many years. That can be the hurdle.
Right. So many different avenues to explore. It really drives home the point that equity release, while it has its place, is just one single tool in a much bigger financial planning toolkit. Finding the right combination is key.
Okay, this has been really insightful. It's clear there's a lot of complexity here, and let's be honest, some significant risks mixed in with those benefits we talked about. So how can someone navigating this make sure they're protected? How do they ensure they're making the right choice for them, for their family, and not rushing into something they might later regret?
That's the crucial question, isn't it? And consumer protection is, thankfully, taken very seriously in this market. The main body here is the Equity Release Council, ERC. They exist to set and maintain high standards for the industry. Providers who are members have to follow a strict set of rules, including their latest Standards 2.0, which came in around May 2025. These standards give you some really key protections. Let me run through the main ones. First, fundamentally, you have the right to remain in your home for life, or until you need to move into permanent long-term care. That's as long as you stick to the terms and conditions of your agreement, of course. Second, that really important no negative equity guarantee, or NNG. We touched on this. It guarantees you'll never owe more than what your property is eventually sold for. Again, assuming it's sold for the best price, reasonably obtainable, and you've met the terms. This protects your estate from inheriting debt. Third, there's the option to move home and take the plan with you portability, though it's always subject to the lender's criteria for the new property. It gives flexibility. Fourth, the ability to make those voluntary, penalty-free repayments, usually up to 10% of the initial loan each year on new plans. This gives you more control over the debt buildup. And finally, a really important one under the newer standards. Early repayment charges are waived if the reason for ending the plan is moving permanently into long-term care. You need that medical certificate, but it removes a potential financial sting in a difficult situation. So these are all designed to build trust and protect the homeowner.
That's a really solid set of safeguards from the industry body itself. That's reassuring. But rules are one thing. Who actually guides you, the individual, through this complex and, let's face it, quite emotional decision? Who are the experts you absolutely must speak to?
Right, because the rules need applying to your specific situation. And the answer is, independent professional advice is not just a good idea, it is absolutely crucial and it's mandatory. You cannot take out equity release without it. And it's a two-pronged approach, really, for full protection. Firstly, you must get advice from an independent financial and mortgage advisor. They need to be regulated by the Financial Conduct Authority, the FCA, and importantly, they should specialize in later life lending or equity release specifically. Their job is to really understand your finances, your needs, your future plans, even consider things like your health. They must explore all the alternatives with you downsizing, using pensions, REOs, everything we discussed. Only then can they recommend equity release if, and only if, it's genuinely suitable for you. They are your financial guide. Secondly, you also must receive independent legal advice from a solicitor. They need to be regulated by the Solicitor's Regulation Authority, the SRA. The solicitor's role is different. They explain all the legal stuff, the contract, your obligations, the risks, the benefits. They usually do this face-to-face.
They also have a duty to check. You understand everything, that you have the mental capacity to make the decision, and crucially, that you're not being pressured into it by anyone. They are your legal safeguard. And good advisors now also strongly encourage involving your family in the discussions. They're appropriate. And they'll almost certainly talk to you about things like setting up or reviewing lasting powers of attorney, OPAs, and making sure your will is up to date. It's all part of safeguarding your future.
Okay, mandatory financial advice and mandatory legal advice, both independent. That really underscores the seriousness of the decision. It's not just about reading a brochure online. It's about having qualified experts who are legally obliged to act in your best interest, walk you through every single aspect. That provides real confidence, doesn't it? So wrapping things up, we've taken a pretty deep dive into equity release today. We've looked at how it can be a powerful tool to unlock the value tied up in your home. We've seen it offer significant financial flexibility, which can be transformative in retirement. But, and it's a big but, it also comes with really considerable implications for your inheritance, potentially for state benefits, and for your overall long-term financial picture. The crucial takeaway, I think, from our whole conversation is crystal clear. This is definitely not a one-size-fits-all solution, not by a long shot. Carefully weighing up those benefits against the potential drawbacks, seriously considering all the alternatives we talked about, and absolutely essentially seeking that truly independent, expert financial and legal advice. Well, these aren't just recommendations. They are fundamental steps you must take to ensure any decision aligns perfectly with your unique circumstances, your family situation, and your hopes for the future. And maybe a final thought to leave you with. Given that equity release can significantly reduce the inheritance you leave behind, and perhaps even impact your own future financial security if unexpected costs like long-term care arise later. Well, it raises a really profound question, doesn't it? Is using your home's value now, whether for your own immediate comfort or maybe to gift money to younger generations, is it truly a gift if it potentially compromises your own future security or significantly diminishes the legacy you planned to leave? What's the right balance for you between living comfortably today and securing your future and the future of your estate? That's a deeply personal question and one worth pondering long and hard.